In this video, we'll show you 3 beaten-down stocks that Cathie Wood is aggressively buying right now, and why these companies could become some of the biggest comeback stories of the next decade. These are not ordinary businesses. One is helping governments and corporations make decisions using artificial intelligence. Another is trying to reinvent the architecture powering the AI revolution itself. And the third sits at the center of the digital asset economy. All 3 have been crushed by the market, and Cathie Wood thinks that may be creating an opportunity. Let's start with the first stock. Palantir Technologies, ticker symbol PLTR. A few years ago, it felt like Palantir stock could do no wrong. The company became one of Wall Street's favorite AI plays. Investors piled into the stock as governments, defense agencies, and corporations rushed to adopt artificial intelligence and advanced data analytics. The excitement pushed shares higher year after year. In fact, Palantir stock more than doubled in each of the last 3 years. Then something changed. The market suddenly became worried about valuations, profit expectations, and whether AI stocks had simply gotten too expensive. Since peaking in early November, Palantir shares have fallen roughly 48% from their all-time high. For many investors, that kind of decline is terrifying. For Cathie Wood, it might be exactly the kind of setup she looks for. Because when you strip away the stock chart and focus on the business itself, Palantir may actually be stronger than ever. The company solves one of the biggest problems in the modern economy. Data is everywhere. Governments generate mountains of information every day. Businesses collect customer data, supply chain data, financial data, and operational data. The challenge is not collecting information anymore. The challenge is turning that information into better decisions. That is where Palantir comes in. Its software platforms help organizations organize massive amounts of information and use artificial intelligence to find patterns, improve operations, and make decisions faster. Its technology has been used in defense, national security, healthcare, manufacturing, and energy. Once a customer integrates Palantir's software into its operations, switching away becomes difficult and expensive. That creates a powerful competitive advantage. This is not a business selling a simple app. It is becoming part of the operating system that organizations use to make critical decisions. And the numbers are becoming increasingly difficult to ignore. Palantir's revenue growth has been accelerating at an incredible pace. Revenue increased 17%, then 29%, and then 56% over the last 3 years. But things have gotten even more impressive recently. The company delivered a 70% increase in revenue during the fourth quarter of last year. Then it followed that up with an even bigger 85% jump in the first quarter of this year. Think about that for a moment. This is not a tiny startup growing from a small base. This is a company that has already reached significant scale and is now producing some of the strongest growth numbers in its history. In fact, Palantir has just reported its 2 strongest quarters of revenue growth since becoming a public company 6 years ago. That is remarkable. And the bottom line is even more impressive. Earnings have more than doubled for 5 consecutive quarters. In its latest report, earnings increased by more than 4 times. That kind of earnings acceleration is rare. Usually, companies growing this quickly are sacrificing profitability to chase expansion. Palantir is doing both. It is growing rapidly while simultaneously becoming much more profitable. So why has the stock collapsed? The answer comes down to valuation. Earlier this year, investors were willing to pay almost any price for exposure to artificial intelligence. Multiples soared into extreme territory. Even after the recent decline, Palantir still trades at around 74 times this year's earnings and about 52 times next year's adjusted profit expectations. Those are not cheap valuations by traditional standards, but context matters. Just a few months ago, those valuation multiples were well into the triple digits. The stock has become dramatically cheaper, while the business itself has become dramatically better. That is exactly the type of disconnect that attracts investors like Cathie Wood. She looks for companies with massive long-term potential that have temporarily fallen out of favor. And there is another reason why Palantir's future may still be very bright. Its business is no longer dependent solely on government contracts. For years, many investors viewed Palantir as primarily a defense and intelligence company. That has changed. Commercial businesses are increasingly adopting the company's AI-powered platforms to gain competitive advantages. Companies want to automate operations, they want to make better decisions, they want to reduce costs, and they want to use artificial intelligence to improve productivity. Palantir is becoming one of the companies helping them achieve those goals. The opportunity in the commercial sector could be enormous. If artificial intelligence truly transforms the global economy over the next decade, companies that help organizations implement AI solutions could become some of the biggest winners. Palantir is positioning itself right at the center of that trend. Of course, there are risks. The stock is still expensive. Expectations remain high. Any slowdown in growth could put additional pressure on the share price. And investors should expect significant volatility along the way. But if management continues executing at this level, today's valuation may eventually look far more reasonable than it appears right now. Sometimes the best opportunities emerge when great businesses experience temporary corrections. Palantir may be one of those situations. The company is growing faster, its profits are exploding, its commercial business is expanding, its competitive advantages remain strong, yet the stock is nearly half of what it was at its peak. That combination explains why Cathie Wood is loading up on shares. She appears to believe that the market is focusing too much on the recent decline in the stock price and not enough on the accelerating strength of the underlying business. And if she is right, Palantir could eventually reward patient investors who are willing to think beyond the next quarter and focus on the next decade instead. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second stock that Cathie Wood has been buying aggressively. Cerebras Systems, ticker symbol CBRS. If Palantir is helping companies use artificial intelligence, then Cerebras is trying to change the very infrastructure that makes artificial intelligence possible in the first place. And that is a much bigger ambition than most people realize. The entire AI revolution depends on computing power. Every advanced AI model requires enormous amounts of processing capability. Companies are spending billions of dollars to build larger and larger AI systems. The problem is that today's computing infrastructure is becoming increasingly complex. Training large AI models often requires connecting hundreds or even thousands of chips together. That creates bottlenecks. It increases costs. It consumes massive amounts of energy. And it can slow down performance. Cerebras believes there is a better way. Instead of relying on countless smaller chips wired together, the company has developed a radically different architecture built around an extremely large processor made from a continuous sheet of silicon. In simple terms, Cerebras is trying to eliminate many of the inefficiencies that exist in traditional AI computing systems. If its technology works at scale, it could become one of the most important infrastructure companies in artificial intelligence. That is the bull case, and it is a very powerful one. Investors certainly believed in that vision when the company went public. Cerebras became one of the most celebrated initial public offerings of the year. Demand for shares was so strong that the company had to raise its offering price to $185 per share ahead of its mid-May debut. Even that proved too conservative. The stock opened at around $350 on its very first trading day. For a brief moment, investors believed they were looking at the next great AI winner. Then, reality hit. The stock began falling almost immediately. Since reaching its peak on May 14th, shares have lost more than half of their value. The company officially became what Wall Street calls a broken IPO. That phrase sounds harsh, but it simply means that the excitement surrounding the public debut faded quickly and investors began questioning whether expectations had gotten too high. This is exactly the type of situation that often attracts Cathie Wood. She is willing to step into unpopular stocks when she believes the market has become too pessimistic. But does Cerebras deserve that optimism? The answer is complicated. The company's first earnings report as a public company delivered both encouraging news and significant concerns. Let's start with the positives. Revenue surged 94%. For almost any company, that would be considered phenomenal growth. A business nearly doubling its revenue is obviously doing something right. It suggests that demand for the company's products remains very strong. It also reinforces the idea that artificial intelligence infrastructure spending is still in its early stages. The market opportunity ahead could be enormous, but investors quickly notice several problems. First, the company's margins have been getting thinner. That means Cerebras is not converting its impressive revenue growth into profitability as efficiently as many investors had hoped. Rapid growth is exciting. Profitable growth is even better, and right now, investors are still waiting to see whether Cerebras can eventually generate strong earnings from its business model. Then there is another issue that may be even more important: customer concentration. Nearly 3/4 of the company's quarterly revenue came from just 2 customers in the United Arab Emirates. That is a huge risk. Imagine building an entire investment thesis around a company only to discover that losing 1 or 2 major customers could dramatically impact revenue. That concentration makes future results less predictable. It increases uncertainty, and the market hates uncertainty. Then there is the issue of the order backlog. At first glance, the numbers look incredible. Cerebras has an order backlog approaching $25 billion. For a company that generated about $604 million in trailing revenue, that sounds almost unbelievable. Investors naturally look at those numbers and start imagining explosive future growth, but there is an important detail. Approximately $20 billion of that backlog comes from a multi-year agreement with OpenAI. That is both encouraging and concerning. It is encouraging because it validates the company's technology. One of the world's most important artificial intelligence organizations is committing enormous resources to Cerebras. That is not something that happens by accident. But it is also concerning because it further highlights customer concentration risk. When one relationship becomes that important, investors have to pay very close attention. A change in that partnership could have significant consequences for the company's future. This is what makes Cerebras such an interesting investment opportunity. The upside could be extraordinary. If its architecture becomes widely adopted, the company could become a foundational player in artificial intelligence infrastructure. The demand for computing power is still exploding. Artificial intelligence models continue getting larger. Businesses and governments continue investing heavily in AI capabilities. And there is no indication that this trend is slowing down. The long-term opportunity remains enormous, but the risks are equally significant. The company is still young, its business model is still being proven, profitability remains uncertain, customer concentration is high, and investors are still trying to determine exactly how much this company should be worth. This creates a classic high-risk, high-reward situation. The stock's collapse has made many investors lose interest. Yet that may be precisely why Cathie Wood is buying. Her investment philosophy has always focused on disruptive innovation. She looks for companies attempting to change industries rather than simply participate in them. Cerebras certainly fits that description. The company is not trying to build another ordinary chip business. It is trying to redefine how artificial intelligence computing works. That is an incredibly ambitious goal. Most companies attempting something this bold fail, but the few that succeed can create tremendous value for shareholders. That is why investors need to think carefully about risk versus reward. Cerebras could become one of the biggest winners of the AI era. Or it could struggle under the weight of competition, customer concentration, and execution challenges. At today's much lower share price, Cathie Wood appears to believe the potential reward outweighs the risks. Whether she is right remains to be seen. But one thing is clear, this is not a stock for investors looking for certainty. This is a stock for investors willing to accept volatility in exchange for the possibility of outsized returns. And sometimes, those are exactly the kinds of opportunities that end up producing the biggest winners over the long term. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's turn to the third and final stock Cathie Wood has been buying. Coinbase Global, ticker symbol COIN. Unlike Palantir and Cerebras, Coinbase is not an artificial intelligence company. Its future is tied to something just as disruptive and just as controversial: cryptocurrency. Few companies are more closely connected to the digital asset economy than Coinbase. The company operates one of the world's leading platforms for buying, selling, and storing digital currencies. For millions of users, Coinbase serves as the gateway into crypto investing. That position gives the company tremendous leverage to the growth of the entire digital asset industry. When cryptocurrencies rally, trading activity surges. When trading activity surges, Coinbase makes more money. And when investor enthusiasm explodes, Coinbase's profits can increase at an astonishing pace. But there is another side to that equation. When cryptocurrencies enter a downturn, everything works in reverse. Trading volumes shrink, investor participation declines, revenue falls, profits can disappear almost overnight. That is exactly what investors have been dealing with recently. Like Palantir and Cerebras, Coinbase shares have been under heavy pressure. The stock recently tumbled sharply and has been cut roughly in half from its 52-week high. At one point, shares fell to a fresh 2-year low. The reason is simple: interest in cryptocurrencies cooled dramatically. Bitcoin itself has fallen approximately 45% over the past year, weighing heavily on sentiment across the entire digital asset market. As trading activity slowed, Coinbase's financial results began reflecting the weaker environment. Revenue declined 22% in one quarter and then fell another 31% in the following quarter. Because Coinbase is a highly scalable business, changes in revenue can have an outsized impact on profitability. When activity is booming, earnings can skyrocket. When activity slows, profits can come under intense pressure. This extreme cyclicality is one of the biggest reasons why many investors avoid the stock entirely. The business can feel unpredictable, and Wall Street generally prefers predictability. But Cathie Wood has never been afraid to invest in areas of the market that others consider too volatile. In fact, she often sees volatility as an opportunity. To understand why, you have to look beyond the current downturn and ask a much bigger question. What if cryptocurrencies and blockchain technology are still in the early innings? That is the investment thesis. If digital assets continue gaining adoption over the next decade, platforms like Coinbase could become essential pieces of financial infrastructure. The company has spent years building its brand, developing regulatory relationships, and expanding its ecosystem. For many new investors entering crypto, Coinbase remains one of the most recognizable and trusted names in the industry. That trust matters. Financial services businesses are built on trust. People want to know that their assets are secure and that the platform they use will still be there years from now. Coinbase has spent years establishing that credibility. The company has also been working to diversify beyond simple trading fees. Management understands that relying solely on transaction revenue can make the business extremely cyclical. As a result, Coinbase has expanded into subscriptions, services, institutional offerings, and other products designed to create more stable revenue streams. Those efforts may not eliminate volatility entirely, but they could make the company more resilient over time. And resilience matters because the cryptocurrency industry has always moved in cycles. Periods of euphoria are often followed by painful corrections. Then, just when many investors begin to lose interest, a new cycle starts. The challenge is that nobody knows exactly when that next cycle will begin. That uncertainty creates opportunity for contrarian investors. The market often prices stocks based on current conditions rather than future possibilities. When conditions are weak, investors assume they will remain weak forever. History suggests that is rarely the case. The same thing can happen in the crypto market. A major recovery in digital assets could dramatically improve Coinbase's financial performance. Higher prices could attract new investors. Higher prices could increase trading activity. Higher prices could improve profitability. In many ways, Coinbase is a leveraged bet on the future of cryptocurrencies. That is both the attraction and the risk. If the digital asset economy continues growing over the long term, Coinbase could benefit enormously. If adoption disappoints or the industry faces prolonged weakness, investors could experience significant volatility. This is not a stock for conservative investors. It is a stock for people who believe that digital assets and blockchain technology will play a much larger role in the future financial system. Cathie Wood clearly falls into that camp. She has long argued that disruptive technologies create some of the greatest investment opportunities, especially when short-term fear causes investors to abandon them. That appears to be exactly what is happening with Coinbase today. The stock has been battered, sentiment is weak, many investors have given up on the sector, yet those conditions often create opportunities for patient investors willing to think years into the future. That does not guarantee success. There are plenty of risks. Regulatory uncertainty remains an issue. Competition remains intense. Cryptocurrency prices can remain volatile for extended periods, and there is no guarantee that another major crypto rally is around the corner. But investing is ultimately about probabilities. Cathie Wood appears to believe that the probability of long-term success is much higher than the market currently expects, and that is why she continues buying shares while others are heading for the exits. So what do these three stocks have in common? At first glance, not much. One is helping governments and corporations deploy artificial intelligence. Another is reinventing the hardware powering the AI revolution. And the third sits at the center of the digital asset economy. But they all share one important characteristic. Each company is attempting to shape the future of an industry that could look very different 10 years from now. And each stock has suffered a major decline that has scared away many investors. Cathie Wood sees those declines not as reasons to panic, but as opportunities to invest in disruptive businesses at lower prices. Whether she is right remains to be seen. But history has shown that some of the best long-term investments often begin when sentiment is at its worst. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage? Palantir, Cerebras, or Coinbase? And which stock do you think has the greatest upside potential over the next decade? Let us know in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.